The richest 1% of people control about $150 trillion in wealth globally, but the world's total debt has reached $324 trillion. Global debt now exceeds global GDP by over 300%. That means even if you took every dollar from every billionaire and millionaire on Earth, you still couldn't pay off half of what the world owes. So where does the other $174 trillion come from? The answer reveals a system where debt isn't just borrowed money. It's digital money creation through modern banking, where typing numbers into computers generates trillions in obligations. This paradox exposes how our entire economy runs on something far stranger than most people realize. The numbers that don't add up. Let's look at the actual numbers behind this strange system. America's debt sits at $36.22 trillion right now, and it's projected to surpass $37 trillion by December 2025. To put that in perspective, if you stacked dollar bills that high, the pile would reach from Earth to the moon and back again 50 times. But America isn't alone in this predicament. China carries $21 trillion in debt. Japan holds $11 trillion. Germany owes $3 trillion. France $3.2 trillion. When you add up every nation on Earth, the total comes to $324 trillion. That's not a typo, $324 trillion. Here's where things get strange. The entire world economy only produces about $100 trillion worth of goods and services each year. So the global debt is more than 3 times larger than everything humanity actually makes, grows, or builds combined. If every person on Earth worked for free and gave away everything they produced for 3 straight years, we still wouldn't have enough to pay off what we owe. Since the pandemic started in 2020, global debt has grown by $82 trillion. That's more than the entire economic output of the United States, China, and Europe combined. In just 5 years, the world added more debt than it had accumulated in the previous 50 years. The numbers have accelerated so fast that economists are running out of ways to measure them meaningfully. But here's the real puzzle. If you took every asset on Earth and sold it at current market prices, you'd get maybe $280 trillion. That includes every building, every piece of land, every company, every gold bar, every stock certificate, and every dollar in every bank account. Liquidate absolutely everything that exists, and you're still $44 trillion short of paying off global debt. The math simply doesn't work. This creates an obvious question. If there isn't enough money or wealth in existence to pay off what we owe, then what exactly is debt? Traditional economics says debt represents money that was borrowed from someone who had it and lent it to someone who needed it. But the numbers prove this can't be true. There isn't enough actual money in the world to account for the debt that exists. Think about it this way. If I lend you $100, I have $100 less and you have $100 more. The total amount of money stays the same. But somehow global debt has grown 3 times faster than global wealth for decades. Money keeps appearing from nowhere, getting lent out, and creating obligations that mathematically shouldn't exist. The strangest part is that this system hasn't collapsed. Every day, countries continue borrowing billions more. Banks keep lending, interest gets paid, the whole machine keeps running despite operating on what appears to be phantom money. Central banks create new currency by typing numbers into computers. Governments issue bonds that people buy with money that didn't exist until the moment they bought them. The debt grows, but somehow so does the economy. This isn't just an accounting error or a temporary imbalance. It's how modern economics actually works. Debt has become a technology for creating wealth rather than just transferring it. When a bank approves a mortgage, they don't take money from their vault and give it to you. They create new money digitally, add it to your account, and simultaneously create a debt obligation. The money supply expands instantly. The debt exists before the money does. Most people assume that when their government borrows money, it comes from wealthy investors, foreign nations, or shadowy financial institutions. But the data tells a different story. The biggest holders of government debt aren't billionaires or foreign powers. They're ordinary institutions that regular people interact with every day. Insurance companies hold trillions in government bonds using premiums from car insurance and life insurance policies. Pension funds own massive portions of national debt, funded by retirement contributions from teachers, firefighters, and office workers. Your own bank account likely contains government debt. When banks hold deposits, they're required to invest a portion in government securities for regulatory reasons. So your savings account is simultaneously lending money to the government and being guaranteed by that same government. The circular nature of these relationships means that traditional ideas about who owes what to whom break down completely. Even more bizarre, many countries are simultaneously major debtors and major creditors. Japan owes $11 trillion, but also holds $4 trillion in foreign government bonds. Germany has $3 trillion in debt while lending $2 trillion to other nations through various financial instruments. These countries are essentially lending money to themselves through complex international networks of banks, funds, and government agencies. The growth rate of this phantom money has accelerated dramatically since 2020. During the pandemic, central banks created more new money in 2 years than they had in the previous 2 decades combined. Government spending programs appeared overnight. Corporate bailouts materialized instantly. Emergency lending facilities provided unlimited liquidity to financial markets. None of this money existed before it was needed, but all of it created new debt obligations. What's particularly unsettling is how normalized this process has become. When the Federal Reserve announces it will purchase $2 trillion in government bonds, financial markets barely react anymore. The creation of massive amounts of debt-based money has become routine. Politicians promise new spending programs worth hundreds of billions without explaining where the money will come from, because everyone understands it will simply be created through borrowing. This system works as long as people have faith that future economic growth will be large enough to support current debt levels. Every loan, every bond, every government obligation represents a bet that tomorrow's economy will be bigger and more productive than today's. The debt isn't really owed to specific people or institutions. It's owed to the idea that human society will continue expanding indefinitely. But mathematical limits exist even for money creation. Interest payments on government debt now consume larger portions of national budgets each year. The US government alone will spend $870 billion on interest payments in 2025. When debt grows faster than the economy that supports it, the burden becomes unsustainable. Several countries are already approaching debt-to-GDP ratios that historically preceded financial crises. The reason the math doesn't add up is because most global debt represents future money that hasn't been created yet. It's a claim on economic activity that may or may not happen. The system depends entirely on the assumption that economies will grow fast enough to validate the debt they've created. If that assumption proves wrong, the phantom money disappears and the debt remains. But the real mystery isn't just the size of these numbers, it's how the money actually moves through the system. The circular money machine. The debt doesn't actually flow from lenders to borrowers in straight lines like most people imagine. Instead, it moves in circles. Money goes out as loans and comes right back as deposits, creating loops that feed themselves endlessly. Take the California Teachers' Retirement System. This pension fund manages $350 billion in assets for retired educators across the state. Where does that money get invested? A huge portion goes into US Treasury bonds. So when a retired teacher receives her monthly pension check, that money originally came from the US government paying interest on bonds that her own pension fund bought with contributions from active teachers. The government borrows money from teachers to pay retired teachers, while current teachers fund the system that will eventually pay them. Everyone is simultaneously lending to and borrowing from the same pool of money. This pattern repeats across the entire financial system. US pension funds collectively held $4 trillion in Treasury bonds as of 2024. These aren't foreign investors or shadowy financial institutions. They're retirement systems for firefighters, police officers, nurses, and government employees. The money comes from payroll deductions that get pooled together and lent back to the same government that employs these workers. A postal worker in Denver contributes to a federal pension system that buys Treasury bonds, which fund the postal service that pays his salary. The circle completes itself. Your bank account works the same way. When you deposit $10,000 into a savings account, the bank doesn't lock that cash in a vault with your name on it. Instead, they're required by federal regulations to invest a portion of customer deposits in government securities. U.S. banks held $1.8 trillion worth of Treasury bonds purchased with customer deposits. So your savings account money gets lent to the U.S. government, which uses it to fund programs like Social Security, Medicare, and federal employee salaries. Then the government pays interest on those bonds back to your bank, which credits a portion to your savings account as interest earnings. Your own money travels in a complete circle from your pocket to the government and back to your pocket, picking up interest along the way. This circular system has grown explosively since 2020. During the pandemic, the Federal Reserve created $4 trillion in new money to purchase government bonds. But where did they buy those bonds from? Primarily from banks, pension funds, and insurance companies that had originally purchased them with deposits, premiums, and contributions from ordinary Americans. The Fed essentially bought government debt from institutions using newly created money, which those institutions then used to buy more government debt. The circle expanded, but the fundamental loop remained intact. Consider how this affects a middle school teacher in Ohio. She contributes 8% of her salary to the state pension system every month. That pension system invests heavily in Treasury bonds. The interest payments from those bonds help fund her future retirement benefits. But those same Treasury bonds are backed by federal tax revenue, which includes the income taxes she pays on her teaching salary. So she's effectively lending her own tax money back to herself through the pension system, paying herself interest, and funding her own retirement with the returns. The government acts as a middleman in a transaction where she's both the lender and the ultimate beneficiary. The self-reinforcing nature of these loops becomes apparent when you follow the interest payments. When the US government pays $800 billion annually in interest on the national debt, that money flows directly back to American banks, pension funds, and insurance companies. Those institutions then have $800 billion more to lend, much of which gets invested in more government bonds. The interest payments create new lending capacity, which generates more debt, which produces more interest payments. Each cycle expands the total amount of money moving through the system. But here's what makes this particularly unstable. The loops only work as long as new money keeps entering the system faster than old money leaves. Pension funds need constant contributions from active workers to pay retired workers. Banks need steady deposits to maintain their government bond purchases. If any part of this flow stops or reverses, the circular system starts breaking down. Demographics are already straining these circles. As baby boomers retire, pension funds face more money going out in benefits than coming in through contributions. The California teachers' retirement system, despite holding $350 billion in assets, faces a $107 billion unfunded liability because benefit payments will soon exceed contribution income plus investment returns. When pension funds need to sell government bonds to pay retirees, they're removing money from the circular flow rather than adding to it. The mathematical reality is stark. If pension contributions decline and bank deposits shrink, the circular flow of money that supports government borrowing starts reversing. Instead of money flowing into the system and expanding in loops, money begins flowing out and the loops contract. When loops contract, the government must find new sources of funding or reduce spending dramatically. Most countries are essentially lending money to themselves through these complex financial loops. The appearance of external creditors exists, but when you trace the money flows completely, domestic institutions funded by domestic savers hold the majority of government debt in almost every developed nation. The circles are so intertwined that the distinction between creditor and debtor becomes meaningless. The speed at which these loops can break is what makes the system particularly fragile. Digital money moves instantly. A pension fund can sell $10 billion in government bonds with a few computer commands. When multiple institutions simultaneously need to convert bonds back to cash, the circular flow can reverse in days rather than months or years. But the strangest part of this entire circular system is what happens when governments need more money than these domestic loops can provide. That's when the real magic begins. The ghost money phenomenon. Central banks create reserves electronically to buy government bonds. When the Federal Reserve decided to inject $4 trillion into the economy during the pandemic, a central bank employee sat at a computer, opened a digital interface, and typed in the numbers. $4 trillion appeared on balance sheets instantly. No printing presses ran, no gold moved from storage, no existing money changed hands. The debt existed the moment someone pressed enter on a keyboard. The Bank of England, European Central Bank, and Federal Reserve all operate this way. When the US Treasury needs to fund a new spending program, they issue bonds. The Federal Reserve purchases those bonds by creating new money electronically and crediting the Treasury's account. The entire transaction happens through computer entries. The government suddenly has billions to spend, and the central bank holds billions in new debt obligations. The process sounds almost too simple to be real, but it's documented in central bank publications worldwide. The Bank of England openly states that commercial banks create money when they make loans, and central banks create money when they buy government securities. The European Central Bank describes quantitative easing as creating money electronically to buy bonds. The Federal Reserve's own website explains that they increase the money supply by purchasing Treasury securities with newly created reserves. During March 2020, the Federal Reserve created more money in a single month than existed in the entire U.S. economy in 1980. Their balance sheet expanded by $2.3 trillion in 8 weeks. Every dollar of that expansion represented new debt obligations that appeared purely through digital accounting. The money didn't come from anywhere. It simply started existing when central bank computers recorded the transactions. This ghost money becomes real the moment it enters circulation. When the government spends newly created funds on infrastructure projects, those dollars pay construction workers who deposit them in banks. The digital entries transform into tangible economic activity. Workers buy groceries with money that didn't exist weeks earlier. Grocery stores pay suppliers with funds that originated as computer keystrokes. The phantom currency integrates seamlessly into the physical economy. But the underlying reality remains unchanged. Most of the money supply consists of digital records rather than physical currency. Only about 8% of US dollars exist as paper bills and coins. The remaining 92% lives as electronic entries in computer systems. When banks process electronic transfers, they're moving digital information rather than tangible assets. Your paycheck deposit, mortgage payment, and credit card transactions all involve shuffling numbers between electronic accounts. The pandemic revealed how quickly this system can expand. In 2021, global central banks added $17 trillion in new money within 12 months. That amount exceeded the entire economic output of the United States. Governments launched spending programs worth trillions without raising taxes or cutting other expenses. The money materialized through central bank purchases of government bonds using freshly created digital currency. Emergency lending programs appeared overnight with unlimited funding capacity. The Federal Reserve established facilities that could theoretically create infinite amounts of money to support financial markets. The European Central Bank launched similar programs with no predetermined limits. These facilities didn't tap existing reserves or redirect funds from other sources. They operated by creating whatever amounts the situation required through digital money creation. The speed of expansion has accelerated dramatically since 2020. Central banks now create money faster than economies can absorb it productively. The Federal Reserve's balance sheet grew from $4 trillion to $9 trillion in 2 years. The European Central Bank expanded from 4.7 trillion euros to 8.8 trillion euros. The Bank of Japan reached 740 trillion, equivalent to 130% of Japan's entire economic output. These expansions happened purely through digital money creation rather than economic growth. What makes this particularly unsettling is how normalized the process has become. Financial markets expect central banks to create whatever money governments need. Politicians propose spending programs worth hundreds of billions without explaining funding sources because everyone understands the money will be created digitally. Economists debate the optimal pace of money creation rather than questioning whether creating money from nothing creates sustainable prosperity. The beneficiaries of this system are institutions positioned to receive newly created money first. When central banks buy government bonds, they purchase them from primary dealers who profit from the transactions. When governments spend newly created funds, the recipients benefit from fresh purchasing power before prices adjust to accommodate the expanded money supply. Financial institutions that facilitate these transactions collect fees on trillions in newly created money. But the system depends entirely on public faith in digital money creation. If people lose confidence that electronically created dollars represent real value, the entire structure collapses instantly. Unlike physical gold or silver, digital money has no intrinsic worth beyond social agreement that computer entries represent purchasing power. The numbers in bank accounts only matter because everyone agrees they matter. Historical currency collapses show what happens when this faith disappears. But modern examples like the Bank of Japan's balance sheet, exceeding 130% of GDP, demonstrate how far digital money creation can extend before hitting limits. The mathematics of ghost money creation reveal fundamental problems. When central banks create money faster than economic output grows, each unit of currency represents a smaller slice of actual goods and services. The new money doesn't create new products or increase productivity. It simply divides existing economic output among more currency units. Interest payments on digitally created debt compound the problem. When governments pay interest on bonds purchased with newly created money, they're paying real resources to service obligations created from nothing. The interest comes from tax revenue representing actual economic activity, while the original debt came from computer entries. Real productivity services phantom obligations. Current debt levels require continuous money creation to remain sustainable. If central banks stopped creating new money, governments couldn't refinance existing obligations when they mature. The system has reached a point where stopping money creation would trigger immediate debt crises, but continuing money creation undermines the currency's credibility. Digital money creation has become the primary mechanism supporting government spending worldwide. Most government debt now represents claims on money that didn't exist when the obligations were created. The debt appears real because it generates real interest payments and real economic consequences, but the underlying money supply consists primarily of digital entries rather than tangible wealth. The majority of global debt exists only as electronic records in computer systems operated by central banks and commercial financial institutions. But the institutions buying this digitally created debt aren't just the usual suspects anymore. The new creditor nations. Germany's net external creditor position reached $3.73 trillion in 2024, making it the world's largest creditor nation for the first time since 1991. This shift reflects aging populations in developed nations, creating massive pools of savings that need investment outlets. Unlike Japan's direct investments in emerging market debt, Germany's creditor status comes primarily through portfolio investments in government bonds and corporate securities across multiple countries. The transformation happened remarkably fast. 5 years ago, most financial analysts expected China to dominate global lending as their economy continued expanding. Instead, China's national debt is projected to reach $26.5 trillion by 2029, forcing them to focus on domestic obligations rather than international lending. Chinese banks that once eagerly purchased American and European bonds are now primarily occupied with funding their own government's infrastructure projects and manufacturing investments. The speed of this transformation becomes clear when you examine specific creditor relationships. Saudi Arabia's sovereign wealth fund now holds over $400 billion in foreign government bonds, making them a larger creditor than most European nations. The United Arab Emirates has accumulated similar holdings through their various investment authorities. These oil-rich nations converted decades of energy revenue into massive portfolios of government debt from countries that once dominated the global financial system. But the most dramatic shift involves former colonies lending to their former colonial powers. Nigeria's pension funds hold billions in British government bonds. India's central bank maintains substantial positions in European debt markets. Brazil's development bank has become a significant lender to American corporations and municipalities. The historical irony is striking. Countries that once struggled to secure basic development loans from Western institutions are now financing the retirement systems and infrastructure projects of their former rulers. This reversal creates entirely new forms of economic leverage. When Britain needs to refinance its debt, they increasingly depend on investment decisions made in Riyadh, Abu Dhabi, and Mumbai. American state governments selling municipal bonds find their largest buyers are sovereign wealth funds controlled by nations with fundamentally different political systems and strategic interests. The geopolitical implications multiply when you consider the concentration of these new creditor relationships. A handful of commodity-exporting nations control disproportionate shares of global lending capacity. Saudi Arabia, UAE, Qatar, and Kuwait collectively hold over $2 trillion in foreign government debt. Their lending decisions can determine whether entire countries can refinance their obligations or face default. Energy revenues drive much of this shift. Oil prices above $80 per barrel generate surplus cash that oil-producing nations must invest somewhere. Traditional options like real estate and corporate stocks can't absorb the massive flows generated by energy exports. Government bonds remain the only market large enough to handle hundreds of billions in investment flows from individual countries. The mathematics work differently when your creditors control essential resources. European nations borrowing from Middle Eastern sovereign wealth funds can't simply default on their obligations without risking energy supply disruptions. American states issuing bonds to Gulf nation investors face similar constraints. The debt relationships create strategic dependencies that extend far beyond financial markets. Developing nations are simultaneously becoming creditors and facing debt crises from previous borrowing. Countries like Malaysia and Indonesia lend money to developed nations through their sovereign wealth funds while struggling to service debt from earlier development projects. This creates complex circular relationships where emerging economies lend to developed countries that provide aid and development assistance back to emerging economies. The timeline for these shifts has compressed dramatically. Relationships that historically took decades to develop now change within months. When commodity prices spike, exporting nations instantly gain massive lending capacity. When energy markets crash, previous creditors can disappear from bond auctions overnight. The Federal Reserve tracks foreign government bond holdings monthly because the composition changes so rapidly. China presents the most complex case in this new creditor landscape. Despite their own rising debt levels, Chinese institutions still hold $1.8 trillion in foreign government securities, but their role has shifted from net lender to selective creditor. Chinese banks now focus their international lending on countries participating in Belt and Road Initiative projects, creating strategic rather than purely financial relationships. The concentration of creditor power in fewer hands creates systemic risks that didn't exist when lending was distributed among many Western financial institutions. If Saudi Arabia's investment committee decides to reduce their holdings of European bonds, entire markets can shift overnight. When Norwegian pension funds adjust their asset allocation strategies, American municipalities notice immediate impacts on borrowing costs. Traditional credit rating agencies struggle to assess these new relationships. Standard & Poor's and Moody's built their models around Western financial institutions with predictable investment patterns. Sovereign wealth funds from authoritarian governments operate with different time horizons and risk tolerances that don't fit conventional analysis frameworks. The political implications extend beyond economics. When Qatar's sovereign wealth fund owns significant portions of French government debt, French politicians must consider Qatari interests when making foreign policy decisions. When UAE investments support American infrastructure projects, American officials face pressure to accommodate UAE strategic objectives. Banking systems in creditor nations have transformed to handle these massive investment flows. Emirates NBD and Qatar National Bank now operate sophisticated government bond trading desks that rival traditional Wall Street institutions. Their decisions about which countries deserve investment affect global interest rates and government funding costs. The reversal has happened so quickly that many political leaders haven't adjusted their thinking. American and European officials still approach international negotiations as if they hold all the financial leverage. But the reality is that their countries increasingly depend on investment decisions made in capital cities they previously ignored. Currency dynamics amplify these power shifts. When oil revenues flow to Middle Eastern creditors, those nations can choose which currencies to hold their debt investments in. Their preferences affect exchange rates and the relative costs of government borrowing in different markets. The traditional debtor-creditor map has been completely redrawn, with former colonies now lending to former empires. But governments aren't the only institutions that have become major players in this debt ecosystem. Private corporations have quietly accumulated massive positions in government securities, transforming themselves into unofficial participants in the global lending system. The corporate debt web. Apple holds $24 billion in treasury securities. Microsoft owns $76 billion worth of government bonds. Amazon maintains $53 billion in various government debt instruments. These aren't financial companies or banks making strategic investments. These are technology corporations that somehow became major creditors to the world's governments while simultaneously running their core businesses selling phones, software, and retail services. When you dig deeper into corporate balance sheets, the numbers become staggering. Corporate America collectively holds over $6 trillion in government debt across all sectors. That's more than the entire GDP of Japan. Manufacturing companies like General Electric hold billions in treasury bonds. Retail giants like Walmart park excess cash in government securities. Even airlines and restaurant chains maintain substantial government bond portfolios alongside their operational assets. But corporations aren't just lending to governments. They're borrowing from each other in ways that create circular dependencies spanning entire industries. Teachers' pension funds hold 8% of all U.S. government debt, illustrating how circular flows connect workers to their own government's borrowing. These educators contribute to retirement systems that purchase treasury bonds, which fund the same government that employs them and pays their salaries. Global corporate debt hit $106 trillion in early 2025, representing the fastest growth rate since records began. That's a 340% increase from pre-pandemic levels. Companies borrowed aggressively when interest rates dropped to near zero, but now they face refinancing those obligations at much higher rates. The corporate debt burden has grown faster than corporate revenues, creating a mathematical problem where companies owe more than their businesses can realistically support through operations. The technology sector illustrates how modern corporations function as shadow banks. Apple doesn't just design iPhones. They operate massive lending operations that rival traditional financial institutions. Apple Card provides consumer credit. Apple Pay processes financial transactions. Apple's corporate treasury manages over $162 billion in various debt instruments, making them a larger creditor than most regional banks. When Apple buys treasury bonds with cash from iPhone sales, they're essentially channeling consumer spending directly into government financing. Amazon's case is even more complex. They issue corporate bonds to fund warehouse construction and logistics expansion. Pension funds buy those Amazon bonds using retirement contributions from Amazon warehouse workers. The workers are simultaneously employed by Amazon and lending money to Amazon through their pension funds. When Amazon pays bond interest, that money flows back to pension funds that pay retirement benefits to former Amazon employees. The circular flow means Amazon workers are financing their own employment and their own retirement through the same debt instruments. Tech giants have become so integral to government financing that their investment decisions affect national borrowing costs. When Microsoft announced they would reduce their treasury holdings by $15 billion in 2024, interest rates on government bonds rose measurably that same week. The market recognized that losing a major corporate creditor would require finding alternative funding sources at potentially higher costs. Private equity firms add another layer to the corporate debt web. Blackstone borrows money through bond issuance to purchase companies. Those acquired companies then issue their own bonds to fund operations under Blackstone ownership. Pension funds buy both Blackstone's bonds and the bonds of companies Blackstone owns. When Blackstone sells a company, the proceeds often get invested in government securities. The money flows in complete circles from pension contributors to private equity to government debt and back to pension beneficiaries. Corporate debt levels now exceed the borrowing capacity of many small countries. Berkshire Hathaway's cash reserves and bond holdings total $325 billion, larger than the annual government budgets of most nations. When Warren Buffett decides to buy Treasury securities with Berkshire's cash, he's making lending decisions that affect global interest rates more than most central banks. The intersection of corporate and government debt creates systemic risks that didn't exist when these markets operated separately. During the 2008 financial crisis, corporate bond defaults triggered government bailouts, which required issuing more government debt, which corporations then purchased with bailout funds. The circular nature of these relationships means that corporate debt problems become government debt problems, and government debt problems become corporate debt problems. Manufacturing companies face particular challenges in this interconnected system. Boeing issues bonds to fund aircraft development. Airlines buy those bonds through their cash management programs while simultaneously purchasing Boeing aircraft with borrowed money. Pension funds for both Boeing and airline employees invest in bonds from both industries. When airlines struggle financially, it affects their ability to buy aircraft, which hurts Boeing's revenues, which impacts both companies' ability to service their debt obligations, which threatens the pension funds that hold their bonds. Insurance companies create additional circular relationships within corporate debt markets. State Farm issues bonds to build cash reserves for claim payments. Corporate pension funds buy State Farm bonds as safe investments. State Farm uses the bond proceeds to purchase Treasury securities and corporate bonds from other companies. When natural disasters trigger massive insurance claims, State Farm sells their bond holdings to raise cash, which reduces demand for corporate debt across multiple sectors. The acceleration of corporate borrowing since 2020 reflects companies positioning themselves as financial intermediaries rather than just operating businesses. Corporations discovered they could borrow money cheaply and lend it to governments at higher rates, profiting from the interest rate spread while maintaining their core operations. This transformation means that companies like Johnson & Johnson now function partially as banks, holding billions in government securities while manufacturing pharmaceuticals. The concentration of corporate debt holdings creates vulnerability to rapid market changes. When credit markets freeze, companies can't refinance maturing bonds, which forces them to liquidate government securities to raise cash. This simultaneous selling pressure can destabilize both corporate and government bond markets within days. Multinational corporations add international complexity to these debt relationships. Apple issues bonds in euros to fund European operations while holding dollar-denominated treasury securities in their corporate treasury. Currency fluctuations affect both sides of their balance sheet simultaneously. When the dollar strengthens, their treasury holdings gain value while their euro-denominated debt becomes more expensive to service. The corporate debt web has become so intricate that distinguishing between lenders and borrowers becomes meaningless. Companies simultaneously borrow from and lend to the same institutions through different financial instruments. But corporations aren't the only unexpected creditors in this system. The biggest lenders might be people you see every day, funding government debt through their retirement savings without even knowing it. The retirement fund paradox. Your monthly paycheck deduction for retirement savings flows directly into government bonds through pension fund investments. U.S. pension funds held 28% of all U.S. treasuries as of Q2 2025, totaling $4 trillion in government debt. The biggest lenders to the U.S. government aren't China or Wall Street banks or billionaire investors. They're teachers in California, firefighters in Ohio, and nurses in Texas, who unknowingly finance the national debt through their retirement contributions. The California Public Employees Retirement System holds $184 billion in government bonds. The New York State Teachers Retirement System owns $97 billion worth. Federal employee retirement funds contain another $312 billion in Treasury securities. When you add up all the pension funds, 401k accounts, and retirement savings across America, regular people collectively own more government debt than any foreign nation. This creates a strange situation where Americans simultaneously worry about government debt while actually owning that debt. Every month when a teacher contributes to her pension fund, that money gets invested primarily in Treasury bonds. The interest payments on those bonds fund her future retirement benefits. She's essentially lending her own money to the government, which pays her interest, which becomes her retirement income. The government borrows from her today to pay her tomorrow with money that includes the interest on what she lent them today. The math works beautifully when more people are working than retiring. Young teachers, firefighters, and government employees contribute to pension systems that buy government bonds. The government uses that money to fund current operations and pays interest back to the pension funds. Meanwhile, a smaller number of retirees draw benefits from those same pension funds. The system generates more money than it pays out, creating a surplus that gets reinvested in more government bonds. But demographics are flipping this equation upside down. The baby boomer generation represents the largest population cohort in American history, and they're all retiring simultaneously. The Social Security Administration projects that by 2034, there will be only 2.3 workers paying into the system for every retiree collecting benefits. Currently, that ratio sits at 2.8 workers per retiree. The decline seems small, but it represents millions of people shifting from contributing to retirement systems to drawing money from them. State and local pension funds face even starker mathematics. The California Public Employees Retirement System covers 2.1 million members, but only 38% of them are actively working and contributing. The remaining 62% are either retired and collecting benefits or will be within the next decade. Illinois Teachers' Retirement System has 432,000 members, but only 166,000 active contributors. These pension funds need constant inflows of new money to pay current retirees. But the number of contributors is shrinking while the number of beneficiaries explodes. The problem compounds because pension fund managers have limited investment options for the massive amounts of money they control. They need safe, predictable returns to meet their obligations to retirees. Corporate stocks are too volatile. Real estate can't absorb hundreds of billions in investment flows. Government bonds remain the only market large enough and stable enough to handle pension fund investments. Federal law actually requires many pension funds to keep substantial portions of their assets in government securities. This regulatory requirement creates a captive market for government debt. Pension fund managers can't simply decide to stop buying treasury bonds even if they think the government is borrowing too much. Their fiduciary duty requires investing in the safest available assets, which means government bonds by definition. The Federal Employee Retirement System, covering 2.8 million federal workers, must invest exclusively in Treasury securities by law. These workers have no choice but to lend their retirement savings to their own employer. The irony becomes apparent when you realize that government employees are financing their own jobs through their retirement contributions. A postal worker pays into the Federal Employee Retirement System every month. That money buys Treasury bonds. The Treasury uses those funds to pay postal worker salaries. The postal worker is essentially paying his own salary through his retirement contributions, while simultaneously creating a debt obligation that his future pension benefits depend on the government being able to honor. Interest payments on the national debt consumed $1.1 trillion of the federal budget in 2024. Much of that money flowed directly back to American pension funds and retirement accounts. So when politicians complain about spending too much on debt service, they're actually describing money that goes to teachers, firefighters, and other public employees through their retirement systems. The government pays interest to the very people who lent them the money in the first place. But this circular system breaks down when more money flows out than flows in. Pension funds facing large numbers of retirees must sell government bonds to raise cash for benefit payments. When they sell bonds instead of buying new ones, they reduce demand for government debt. The government must find alternative funding sources or pay higher interest rates to attract different types of investors. The transition is already happening. State pension funds sold $45 billion in Treasury securities during 2024 to meet increased benefit payments. Corporate 401k plans liquidated another $23 billion in government bonds as baby boomers began withdrawing retirement funds. These sales represent the first time in decades that retirement systems have been net sellers rather than net buyers of government debt. Private sector retirement accounts face similar pressures. Target date funds automatically shift from stocks to bonds as workers approach retirement, then shift from bonds to cash as retirees begin withdrawing funds. Fidelity manages over $4 trillion in retirement accounts and reports that outflows to retirees exceeded new contributions for the first time in 2024. When retirees withdraw money from their 401k accounts, fund managers must sell underlying assets, including government bonds, to provide the cash. The sustainability of this system depends on maintaining the delicate balance between contributions and withdrawals. But demographic trends guarantee that balance will shift dramatically over the next 2 decades. The Congressional Budget Office projects that retirement-related government spending will increase from 8.9% of GDP currently to 13.2% of GDP by 2054. Simultaneously, the workforce contributing to retirement systems will shrink relative to the number of beneficiaries. The mathematical reality is inescapable. When the largest generation in American history stops contributing to retirement systems and starts withdrawing money, those systems must liquidate their government bond holdings. The forced selling will occur simultaneously with increased government borrowing needs. Regular people saving for retirement have unknowingly become the world's biggest government lenders, creating a demographic time bomb that threatens both retirement security and government financing. But pension funds aren't the only institutions required by law to buy government debt. U.S. insurers allocate over 60% of their assets to bonds according to NAIC regulations, making every premium payment an involuntary loan to governments. The companies that promise to protect you from financial disaster have become some of the biggest creditors to the very institutions they're supposed to guard against. The insurance company's secret. When you pay your monthly car insurance premium, you probably think that money sits in an account waiting for potential accident claims. But State Farm doesn't keep your $150 monthly payment in a vault with your name on it. Instead, they immediately invest 64% of all premium payments into government bonds. Your car insurance money becomes a loan to the U.S. Treasury within days of writing the check. Allstate operates the same way, investing $89 billion in government securities using premiums from auto and homeowner policies. Progressive holds $47 billion in Treasury bonds purchased with customer payments. Every month when millions of Americans pay insurance premiums, they're unknowingly funding the national debt. The scale of insurance company government lending dwarfs most people's understanding. American insurance companies collectively hold $2.8 trillion in government bonds as of 2024. That's more than the entire annual federal budget. Property and casualty insurers own $847 billion in Treasury securities. Life insurance companies hold another $1.2 trillion. Health insurers maintain $623 billion in government debt instruments. These aren't voluntary investment choices. Federal regulations require insurance companies to maintain specific percentages of their assets in government securities to ensure they can meet policyholder obligations. Your life insurance policy creates particularly circular relationships with government debt. When you pay premiums for a $500,000 life insurance policy, that money gets invested primarily in Treasury bonds. The insurance company promises to pay your beneficiaries $500,000 when you die, but they're backing that promise with government debt. If the government faces financial difficulties and struggles to repay bonds, the insurance company's ability to honor your policy becomes questionable. You're essentially betting on government solvency to protect your family's financial security. Natural disasters reveal how insurance payouts create more government borrowing in endless loops. Hurricane Ian caused $67 billion in insured losses during 2022. Insurance companies paid these claims by liquidating government bond holdings to raise cash. But the same hurricane triggered massive federal disaster relief spending, requiring the government to issue new bonds to fund recovery efforts. FEMA spent $23 billion on hurricane response, money that came from selling Treasury securities. So insurance companies sold government bonds to pay hurricane claims, while the government simultaneously issued new bonds to fund hurricane recovery. The mathematics become more unstable as climate change accelerates. Insurance industry payouts for natural disasters exceeded $90 billion in 2024, the highest level in history. Each major storm, wildfire, or flood forces insurance companies to liquidate government bond holdings, while simultaneously triggering additional government spending that requires new bond issuance. The circular relationship means that climate disasters both reduce demand for government debt and increase the supply of new government debt simultaneously. Life insurance companies face additional pressures that compound their government debt exposure. Americans are living longer, which means life insurance companies collect premiums for more years before paying death benefits. This extended collection period forces life insurers to find safe investments for decades-long time horizons. Government bonds represent the only market large enough and predictable enough to handle these massive, long-term investment flows. New York Life holds $286 billion in government securities. Northwestern Mutual owns $312 billion in Treasury bonds. These companies have become major government creditors simply because no alternative investments can handle their scale and time requirements. Health insurance companies create additional circular flows between premium payments and government debt. United Healthcare collects $387 billion annually in premiums and invests much of it in government securities. But United Healthcare also participates in Medicare and Medicaid programs, receiving payments from the same government whose debt they hold. The company lends money to the federal government through bond purchases, while simultaneously collecting money from the federal government through healthcare program reimbursements. The acceleration of insurance company government lending since 2020 reflects the industry's limited investment alternatives. Corporate bonds carry higher default risks. Real estate markets can't absorb hundreds of billions in insurance company investments. Stock markets are too volatile for companies that need predictable returns to meet policyholder obligations. Government bonds remain the only asset class that matches insurance companies' need for safety, liquidity, and scale. Workers' compensation insurance creates direct connections between workplace injuries and government debt. When a construction worker gets injured on the job, workers' compensation insurance pays medical bills and wage replacement. Those payments come from reserves invested primarily in government bonds. But workplace safety regulations and enforcement come from government agencies funded by tax revenue. The government borrows money from insurance companies to fund safety programs, while insurance companies pay claims for injuries that might have been prevented by better government oversight. Reinsurance companies add another layer to the insurance government debt web. Primary insurers buy reinsurance to spread their risks, and reinsurance companies invest those premiums in government securities. Munich Re holds $67 billion in sovereign debt. Berkshire Hathaway's reinsurance operations own $98 billion in government bonds. When catastrophic events trigger reinsurance payouts, these companies sell government bonds across multiple countries simultaneously. The regulatory requirement for insurance companies to hold government debt means that every premium payment becomes an involuntary loan to federal, state, and local governments. Policyholders have no choice in these investment decisions, yet their financial security depends entirely on the government's ability to repay the debt that their premiums purchased. But insurance companies aren't the largest holders of government debt. That distinction belongs to institutions that create money specifically to purchase government bonds, making the circular nature of modern debt even more bizarre. The central bank shell game. The Federal Reserve owns $5.2 trillion worth of U.S. government debt. That's roughly 1/4 of all Treasury securities in existence. But here's the strange part. The Federal Reserve is technically owned by the U.S. government. So the government borrowed $5.2 trillion from an institution that the government itself owns. It's like borrowing money from your own wallet and then paying yourself interest on the loan. This accounting sleight of hand happens at central banks worldwide. The European Central Bank holds 4.3 trillion euros in government bonds from member nations while being owned by those same governments. The Bank of Japan owns 562 trillion in Japanese government debt despite being a government entity. The Bank of England holds £875 billion in UK government securities while operating as a government institution. Every major central bank has become the largest creditor to its own government. The process works through carefully constructed legal fictions that make internal lending appear external. When the U.S. Treasury needs to borrow money, they issue bonds through public auctions. The Federal Reserve participates in these auctions just like any other buyer, purchasing bonds with newly created money. The transaction gets recorded as an external debt obligation even though the money came from a government-owned institution and flows back to a government-owned institution. Central bank independence provides the intellectual cover for this circular lending system. The Federal Reserve operates with supposed autonomy from political interference, making decisions based on economic rather than political considerations. This independence allows the Fed to appear as a separate entity when purchasing government debt. But the independence is largely cosmetic when it comes to debt transactions. The Fed consistently purchases whatever quantity of government bonds the market requires to maintain stable interest rates. The accounting tricks become apparent when you examine where central bank profits go. The Federal Reserve earned $76 billion in interest payments from its government bond holdings in 2024. After paying operating expenses and member bank dividends, the Fed remitted $71 billion back to the U.S. Treasury. So the government paid $76 billion in interest to the Fed, and the Fed gave $71 billion back to the government. The government essentially paid itself $5 billion for the privilege of borrowing from itself. Quantitative easing reveals how sophisticated money printing has become. The Federal Reserve's balance sheet grew from $4 trillion to $8.9 trillion from 2020 to 2023 through government bond purchases. The Fed didn't take money from existing accounts or redirect funds from other sources. They generated new currency digitally and used it exclusively for government debt purchases. The European Central Bank operated identical programs, creating euros specifically to buy sovereign bonds from member nations. The circular logic creates mathematical paradoxes that economists struggle to explain. When central banks buy government bonds, they increase the money supply while simultaneously increasing government debt. The new money enters circulation when governments spend the borrowed funds, but the debt remains on central bank balance sheets indefinitely. The government owes money to an institution that created the money from nothing and remits any profits back to the government. Central bank independence becomes meaningless when governments face funding crises. During the 2008 financial crisis, the Federal Reserve purchased whatever quantity of government securities markets required to maintain liquidity. European Central Bank President Mario Draghi promised to do whatever it takes to preserve government bond markets, including unlimited bond purchases. Central banks consistently prioritize government funding needs over their supposed independence from political pressure. The legal structures supporting this system depend on technical distinctions that obscure the underlying reality. The Federal Reserve operates as a government-sponsored entity rather than a direct government agency. Member banks own shares in regional Federal Reserve banks, creating the appearance of private ownership. But the Federal Reserve Board consists of government appointees, profits flow to the Treasury, and policy decisions require government approval. The private ownership structure provides legal cover for what amounts to government self-lending. Modern central banking has evolved into a sophisticated mechanism for governments to borrow from themselves without appearing to print money directly. When the Treasury issues bonds and the Fed purchases them with newly created reserves, the transaction appears as legitimate borrowing on government balance sheets. The debt gets recorded as an external obligation despite the money coming from a government-owned institution and the interest payments flowing back to the government. The limits of central bank debt purchases are becoming apparent as these institutions accumulate massive government bond portfolios. The Federal Reserve holds 23% of all outstanding Treasury securities. The Bank of Japan owns 53% of the Japanese government bond market. The European Central Bank holds 35% of Eurozone sovereign debt. When central banks own such large portions of government debt markets, they control interest rates and government funding costs directly. Market functioning deteriorates when central banks dominate government debt markets. Private investors lose influence over government borrowing costs when central banks provide unlimited demand for government bonds. Price discovery mechanisms break down when artificial buyers purchase whatever quantities governments need to issue. The Congressional Budget Office warns that central bank dominance of Treasury markets could impair the government's ability to assess market appetite for new debt issuance. The concentration of government debt at central banks creates systemic risks that didn't exist when debt was distributed among diverse private investors. If central banks needed to sell their government bond holdings rapidly, no private market could absorb such massive quantities without severe price disruptions. The Federal Reserve holds more Treasury securities than the entire commercial banking system combined. Unwinding these positions would require years of gradual sales to avoid market disruption. Emerging market debt rose by $3.5 trillion in Q1 2025 to $106 trillion, according to the Institute of International Finance, as developing nations struggle with higher borrowing costs. Countries like Kenya saw yields rise 150 basis points after tariff announcements in April, demonstrating how quickly external pressures can destabilize government financing. The IMF's Global Financial Stability Report projects a 5% chance that global growth could fall below 0.4% over the next year, a scenario that would make current debt levels unsustainable across multiple countries simultaneously. International coordination among central banks has synchronized government debt purchases globally. When the Federal Reserve announces new bond buying programs, the European Central Bank and Bank of Japan typically launch similar initiatives. This coordination ensures that government debt markets remain stable across major economies simultaneously. But it also means that government funding crises would affect multiple countries at once if central bank support disappeared. Central banks have become the ultimate creditors by creating money specifically to lend to governments, transforming the traditional relationship between monetary policy and government finance into a system where governments can borrow unlimited amounts from institutions they own. But this circular system of self-lending has mathematical limits that are becoming increasingly apparent as debt service costs consume larger portions of government budgets worldwide. The breaking point signals. Several warning signs indicate the system is approaching critical thresholds that could trigger widespread financial instability. Interest payments on the U.S. national debt now consume 13% of the entire federal budget. That's more than the government spends on defense, more than education, more than transportation infrastructure. In 2020, debt service costs represented just 6% of government spending. The doubling in 4 years signals something fundamental breaking in the system. When governments spend more money paying interest on old debt than funding new programs, they've crossed into dangerous territory. The Congressional Budget Office projects that interest costs will reach $13.8 trillion over the next decade alone. That's not the debt itself. That's just the cost of servicing existing obligations. To put that in perspective, $13.8 trillion exceeds the entire economic output of every country except the United States and China. Americans will pay more in interest on government debt over the next 10 years than the combined GDP of Japan, Germany, and India. The mathematics reveal why this trajectory can't continue indefinitely. Federal spending is projected to rise from 23.3% of GDP in 2025 to 26.6% of GDP by 2055. But tax revenues remain relatively flat as a percentage of economic output. The gap between spending and revenue widens every year, requiring more borrowing to fill the difference. Each new dollar of debt creates additional interest obligations that require even more borrowing to service. The spiral accelerates automatically. China provides a real-time example of how quickly debt ratios can reach critical levels. Their government debt-to-GDP ratio hit 96% in 2025 and is projected to reach 95% by 2027. Historical analysis shows that countries approaching 100% debt-to-GDP ratios face increasing difficulty attracting lenders and maintaining economic stability. China added over $2 trillion in debt during just the first quarter of 2025, indicating their borrowing needs are accelerating rather than stabilizing. The global picture looks even more alarming. Total world debt reached $324 trillion in early 2025, representing an increase of $7.5 trillion in just 3 months. That quarterly increase exceeded the average pace of debt growth by 4 times. The acceleration suggests that debt accumulation is no longer following predictable patterns. Countries are borrowing faster than their economies can absorb the new money productively. Healthcare costs drive much of the unsustainable spending growth in developed nations. The Congressional Budget Office anticipates that federal healthcare spending will climb from 5.8% of GDP in 2025 to 8.1% of GDP by 2055. The Centers for Medicare and Medicaid Services project that total healthcare spending will reach 1/5 of the entire U.S. economy. As populations age, healthcare obligations grow faster than the working-age population that funds them through taxes and contributions. Rising interest rates have transformed manageable debt loads into crushing burdens almost overnight. When governments borrowed trillions at near-zero interest rates between 2010 and 2022, the debt service costs remained affordable. But as central banks raised rates to combat inflation, refinancing existing debt became exponentially more expensive. Countries that could easily service debt at 1% interest rates struggle when those same obligations carry 4% or 5% rates. Japan demonstrates how central bank intervention can delay but not prevent debt crises. The Bank of Japan owns 53% of all Japanese government bonds, artificially suppressing interest rates through massive purchases. But this strategy requires continuous money creation to maintain. When the BOJ attempted to reduce bond purchases in 2024, government borrowing costs spiked immediately. The central bank had to reverse course and resume unlimited bond buying to prevent a funding crisis. Several countries have already hit practical borrowing limits despite maintaining theoretical access to credit markets. Sri Lanka defaulted on foreign debt obligations in 2022. Pakistan required International Monetary Fund intervention to avoid default in 2023. Argentina restructured government debt multiple times in recent years. Turkey faced currency collapse as debt service costs consumed increasing portions of government revenues. These aren't isolated incidents, but early indicators of systemic stress. The demographic transition creates mathematical impossibilities for debt-funded social systems. Birth rates have fallen below replacement levels in most developed countries, while life expectancy continues increasing. Fewer workers must support more retirees through tax-funded programs. Social Security, Medicare, and pension obligations grow automatically, while the tax base shrinks relatively. Countries can borrow to bridge the gap temporarily, but compound interest makes the problem larger every year. Private credit funds reached $2.5 trillion in assets under management during 2024, according to the Institute of International Finance, demonstrating how corporate borrowing has shifted toward less regulated markets. When corporations struggle to service debt obligations, they reduce employment and investment, shrinking the tax base that governments depend on. Simultaneously, corporate defaults often trigger government bailouts that require additional borrowing. The interconnection between corporate and government debt means that private sector problems automatically become public sector obligations. The concentration of debt ownership creates systemic risks that didn't exist when borrowing was distributed among diverse lenders. Central banks now hold massive portions of government debt markets. The Federal Reserve owns 23% of all Treasury securities. When central banks need to reduce their bond holdings, no private market can absorb such quantities without severe price disruptions. The artificial demand from central banks has created artificial pricing that could collapse rapidly if central bank support disappears. Financial markets show increasing signs of stress despite continued government borrowing. Bond market volatility has increased dramatically since 2022. Credit spreads between government and corporate bonds have widened. Currency markets experience greater fluctuations as investors lose confidence in debt sustainability. These market signals indicate that professional investors are pricing in higher default risks across multiple countries simultaneously. The timeline for potential system breakdown has shortened considerably. The Congressional Budget Office projects that U.S. debt will exceed its historical record relative to GDP within 4 years. Multiple European countries face similar trajectories. China's debt growth rate suggests they could reach crisis levels within this decade. Unlike previous debt problems that developed over generations, current borrowing rates could trigger widespread problems within years rather than decades. Multiple indicators suggest the global debt system is approaching a mathematical breaking point within the next decade. Interest costs are growing faster than economic output. Demographic changes make current spending promises impossible to fulfill. Market mechanisms show increasing stress. But when you trace all these warning signs back to their source, they point to something even more fundamental than numbers on government balance sheets. The ultimate revelation. The root cause lies in the fundamental structure of how modern economies operate. After tracing every dollar through pension funds and insurance companies and central banks and corporate treasuries, we arrive at the most startling discovery of all. The world isn't actually in debt to anyone. Not to China, not to billionaires, not to shadowy financial institutions. The global economy owes $324 trillion to an idea. Specifically, the idea that human civilization will be more productive tomorrow than it is today. Every government bond represents a promise that future taxpayers will earn enough money to repay current borrowing. Every corporate bond assumes that companies will generate enough revenue in coming years to service their obligations. Every mortgage depends on homeowners earning steady incomes for decades to come. The entire debt system functions as humanity's collective bet that economic growth will continue indefinitely. This becomes clear when you examine what debt actually represents. When the US government borrows $1 trillion, they're not borrowing existing wealth from current taxpayers. They're borrowing against the productive capacity of Americans who haven't been born yet. Future workers will create goods and services that generate tax revenue to repay today's obligations. The debt exists because we assume those future workers will be more productive than current workers. The mathematics only work if economies grow faster than debt accumulates. The Congressional Budget Office assumes that U.S. economic output will expand by an average of 1.8% annually over the next 3 decades. That growth assumption allows current debt levels to remain manageable as a percentage of total economic activity. But if growth falls below debt accumulation rates, the burden becomes impossible to service through normal economic activity. This explains why every country can simultaneously be a debtor and creditor without the global system collapsing. Nations aren't really lending money to each other. They're all betting on the same outcome through different financial instruments. Japanese pension funds buy U.S. Treasury bonds because they believe American productivity will increase enough to honor those obligations. American insurance companies purchase German government securities because they expect German economic output to grow sufficiently to repay investors. Everyone is wagering on everyone else's future productivity. The growth assumption has worked remarkably well for centuries. Human productivity has increased consistently since the Industrial Revolution began. New technologies, better education, and improved organization have allowed each generation to produce more goods and services than their parents. This productivity growth created surplus wealth that could service debt obligations while still improving living standards. But the foundation supporting this system faces unprecedented challenges. Birth rates have fallen below replacement levels in most developed countries. Japan's population is shrinking by 400,000 people annually. South Korea's birth rate has dropped to 0.78 children per woman, far below the 2.1 rate needed to maintain population stability. Fewer workers must support more retirees while simultaneously servicing debt obligations created when demographics looked completely different. Environmental constraints create additional limits on infinite growth. Climate change requires massive investments in adaptation and mitigation that reduce resources available for debt service. The International Energy Agency estimates that achieving net zero emissions requires $4 trillion in annual clean energy investments through 2030. Those investments may prevent catastrophic warming, but they divert economic output from consumption and debt repayment toward survival necessities. The COVID-19 pandemic demonstrated how quickly growth assumptions can break down. Global economic output shrank by 3.1% in 2020, the largest contraction since World War II. Governments responded by borrowing unprecedented amounts to maintain economic activity during lockdowns. Global debt increased by $24 trillion in 2020 alone, while economic output declined. The debt-to-growth relationship inverted temporarily, providing a preview of what happens when the fundamental growth assumption fails. Technology provides some reasons for optimism about continued productivity growth. Artificial intelligence could automate many tasks currently performed by humans. Renewable energy costs continue declining rapidly. Medical advances extend healthy lifespans and reduce healthcare costs for some conditions. These technological improvements could theoretically maintain productivity growth despite demographic and environmental challenges. But technology also creates new forms of systemic risk. Artificial intelligence could eliminate millions of jobs faster than new employment opportunities emerge. Cybersecurity threats could disrupt critical infrastructure systems. The same technologies that boost productivity also threaten the social stability necessary for economic systems to function. The concentration of wealth and income in developed countries creates additional threats to growth-based debt systems. When inequality increases, consumer spending power declines because wealthy individuals save larger portions of their income than middle-class families. Reduced consumer demand limits business revenues and employment growth. Rising inequality reduces overall economic growth rates over time. Financial markets increasingly recognize these fundamental challenges to perpetual growth. Long-term interest rates reflect investor skepticism about future economic expansion. Bond yields in many countries remain below historical averages despite massive government borrowing, suggesting that markets expect slower growth for extended periods. The revelation changes everything about how we understand money and debt. Instead of viewing debt as money borrowed from specific creditors, we can see it as humanity's promise to itself about future capabilities. The real question isn't who owns global debt, but whether human civilization can deliver on its collective promise of endless productivity growth. Some economists argue that debt levels don't matter because governments can always create more money to service obligations. But money creation without corresponding productivity growth just redistributes wealth rather than creating new wealth. Printing money to pay debts works temporarily, but eventually undermines the currency's credibility and purchasing power. The transition to post-growth economics won't happen voluntarily while current systems still function. Politicians can't campaign on slower growth platforms. Businesses can't plan for declining revenues. Pension funds can't promise retirement security without investment returns. The existing institutional framework requires growth assumptions to maintain legitimacy. This massive global wager on perpetual expansion has created the most audacious gamble in human history. The numbers tell the complete story of how modern economics actually functions. We've discovered that global debt of $324 trillion isn't owed to foreign governments or billionaire overlords. It's humanity's bet on infinite growth on a finite planet. Every bond, every loan, every mortgage represents our collective promise that tomorrow will be more productive than today. You're simultaneously a creditor through your pension funds and insurance premiums, and a debtor through government spending that benefits you. Global debt to GDP stands at 324%, meaning the world owes more than 3 times what it actually produces. This system worked when populations grew and resources seemed endless. But with aging societies and environmental limits, the growth assumption faces unprecedented challenges according to IMF growth at risk projections. The real question isn't who we owe money to, but whether we can keep our promise to ourselves. Consider how this debt system shapes your daily life through every paycheck deduction, insurance premium, and government service you encounter.